So my name is Rob. I organize Idea to IPO. We've been doing events in Silicon Valley for many years. We always have a busy calendar of events. I want to highlight two events that are coming up. September 12th, fireside chat with George Zachary of Charles River Ventures. That's going to be in Palo Alto. September 19th, Deep Learning 101. That's going to be in this room. So check out the details for those events and all of our events on our website, ideatoipo.com. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 60,000 members among all our meetup groups in the Bay Area. We've organized, promoted, and produced over 2,100 events. We're the most active, most prolific startup event organization in Silicon Valley, bar none. Thank you. Our mission is to promote entrepreneurship, support entrepreneurs, build community, and provide value in the Silicon Valley startup ecosystem. To that end, we provide content that is practical, actionable, and relevant, stuff you can actually use to succeed as entrepreneurs. We believe in building community because Silicon Valley is an aspirational ecosystem. It attracts people from all over the world who come here to do great things. Who here is not originally from Silicon Valley or the Bay Area? Who here was born and raised in Silicon Valley or the Bay Area? 3 natives. Let's hear it for the natives. So whether you were born and raised here or just arrived last night, it is important for us to provide multiple channels for you to meet people, build relationships, and grow your network. In addition to our content-oriented events throughout the week, we also have some fun events on Friday nights. The next one is actually Friday the 13th, September 13th. We're celebrating Friday the 13th with a TGIF mixer at the Hyatt Regency Santa Clara. A few miles from here. You're all invited on Friday the 13th. Check it out. With regard to value, it is important that we provide value at each and every one of our events. So we make sure our events are affordable because we know many entrepreneurs are struggling financially. If you cannot afford the cover charge for whatever reason, come talk to me and we can work something out. And at each and every one of our events, we make sure that we provide a delicious buffet meal. Is that a delicious buffet meal? Yes. Well, let's hear it for Royce Law Firm for sponsoring that delicious buffet meal. Special thanks to our executive chef, Carlo, for his meticulous preparation. Applause. Most importantly, though, at each and every one of our events, we want to make sure we provide value for your time, which is your most valuable resource. I have to ask, is anyone here getting any younger? Besides our speaker and that young man? So when you invest your valuable time to come to our events, we want to make sure that you maximize your ROI. We have many partners that help us do what we do. Law firms, venture capital firms, angel investor groups, incubators, accelerators, colleges, universities, co-working spaces. Tonight, we're grateful to SVI Hub for hosting us at this beautiful venue. Is this a beautiful venue? So let's hear it for SVI Hub and Wendy. Wendy, come on down.
Hello and good evening. I would like to thank you all for joining us here at SVI Hub. SVI Hub is a co-working space that offers office solutions such as flex seating, dedicated seating, and private offices. We also offer a variety of other services such as our SVI Academy, which is training, workshops, professional development for businesses and startup companies. We also offer accelerators and corporate innovations for larger corporations. If you guys have any questions or would like any additional information, feel free to see me after. Thank you for your attention.
A few of our other partners are here tonight. I would also like to have them come up and say a few words. Let's hear it for Rahat and Coldwell Banker. Applause.
Good evening, everyone. My name is Rahat Subadar, and I'm an effective real estate negotiator. So my whole philosophy is it's very important to have good information. Without good information, you can't make good decisions. If you're thinking about making any type of real estate decisions, please feel free to reach out to me. Thank you and have a great evening.
All right, next up we have Bridget and S5 Advisory. Applause.
Hi everyone, I'm Bridget. Sushma Malhotra is also here as well from our team. We're S5 Advisory. We're a commercial brokerage firm. We specialize in advising companies with their space needs, whether it be office, retail, R&D, biotech, anything like that, we can help you out. Thanks.
All right, next up we have Anita from Happiness Factors. Applause.
Hi, this is Anita from Happiness Factors. And at Happiness Factors, we believe that we can create and sustain happiness without the use of drugs, marijuana, or alcohol. And currently, we are in the MVP stage, and we have a remote team developing our product in India, and we are actively looking for a CTO. And apart from the technical skills, it's very important for us that the person is very ethical, very honest, and team-oriented person. And of course, some familiarity with AI, AR, and the app market will be very good. So if you know someone who might be a good fit, please let me know. And if you want to find out more about Happiness Factors, I have my table out there, as well as the standee, I guess, for the want of a better word. And if you want to make a difference in the world and make the world a happier place, then also come and see me. Thank you. Thank you, Rob.
I've got some ice cream in the back. That'll make some people happy, and I think that's okay. So come see me if you want to check that out at the end of the program. Here's the schedule for the rest of the evening. We're going to go right into our featured speaker's presentation. He's got an awesome slide deck. Audience members, hold your questions. We're going to open up the questions at 8 p.m. We'll take as many questions as possible. That'll take us all the way to 8:30 p.m. At 8:30 p.m., we have a raffle. You'll have a chance to win one of 3 copies of Roger's awesome book, Dead on Arrival, How to Avoid the Top 10 Legal Mistakes That Could Kill Your Startup. We'll break at that point. You can hang around, network, socialize, connect. As a courtesy to SBI Hub, we would like to leave the building by 9 p.m. So without further ado, I want to introduce our featured speaker tonight. He is one of the top startup and corporate attorneys in Silicon Valley. He's the founder of Royce Law Firm. Actually, he's an iconic figure in Silicon Valley. He's everywhere. He's at conferences, meetups, social events, the Rosewood. He's everywhere. So let's give it up for Roger Royce.
All right, thanks, Rob. Thank you all for being here. I appreciate you coming back from Burning Man early just to attend this event on how to raise money for how to get your startup ready for venture capital funding. So I'm Roger Royce. I'm the founder of the Royce Law Firm. We're a business, corporate, and tax firm based in Menlo Park, right down the road. Office in San Francisco, Los Angeles. We work with technology startups. We've been doing it for 14 years. I've been doing it for a lot longer than that. I've been in the Valley since '91. And today we're going to talk about that holy grail for startups. What everybody wants is the VC round, what everybody thinks they want. So let me ask, how many of you folks in the audience are startup entrepreneurs? How many investors? A couple. How many service providers like me? Oh, wow, more than usual. Okay. All right. Did I miss anybody? Academics, government, scientists? Okay. We've got a really good, diverse group here, don't we? So what I'm going to do today, or tonight, is to go, I'm a lawyer, so it's one of my personality flaws, so you're going to have to deal with the fact that I look at things from mostly a legal standpoint. And I'll go through really some of the things you want to have in place for your, by the way, can you hear me in the back okay? Raise your hand if you can hear me. Raise your hand if you're listening. All right. We'll go through some of the things, well, all of the things really that you need to have in place as a legal matter so that when you arrive at the gates of hell ready to do business with the venture capitalists, you're going to have everything they expect you to have in place. And then we'll spend some time going through a term sheet so you're at least familiar with the language and the terms and the concepts. And because once you enter the VC world, it becomes a lot different. People start, using industry terms you might not be familiar with, and it's really good that you do that. Now, I know a lot of you, especially if you're successful companies, you already have lawyers, or you know where to find a lawyer, or you've got a phone book, or you have Google, but you're doing the right thing by coming to events like this and understanding yourself what it is that you need to know. Because you cannot assume that people are going to tell you this stuff, right? You absolutely cannot assume that, especially in this valley where everything seems to be driven by what's market, right? What's market might not be something you're all that cool with. So it's great that you understand this stuff going in, so you know what to ask for. When people throw terms at you, you understand what they mean, and you know what you're getting in for. Let's get that out of the way. Right? This is not legal advice. This is just some guy talking. All right. So let's start off. It's axiomatic that VCs will only invest in C corporations, right? So there's really three main types of entities that you would use to form your company. And I want to start with this, and those of you who have seen me before, you know I talk a lot about this, choice of entity. And to cut to the chase, there's three kinds. There's a limited liability company, extremely flexible and tax advantageous as a general rule. There's an S corporation, very inflexible but tax advantageous for most companies. Then there's a C corporation, inflexible and not tax advantageous at all. But every company that gets venture is going to be a C corporation. Anyone know why that is? So I'll tell you, venture funds, and we form venture funds as well, their organizing documents always restrict them as to what they can invest in. It prohibits them from investing in pass-throughs, which is what the first one and the last one, the limited liability company and the S corporation are. So they're really restricted by their organizational documents from doing anything but a C corporation. Now, a C corporation, that means a state law corporation. You file articles or a certificate in Delaware. It's created by statute. And the difference between that and an S corporation is any state law corporation that makes a special election under subchapter S of the Internal Revenue Code to be taxed as a pass-through, meaning that the owners pay tax on the income of the entity doesn't pay a separate tax. So there's one level of tax instead of two, because the owners pay tax on it. If you're not going to get venture finance, in fact, you get outside this valley, and you'll see LLCs and you'll see S corps, way more S corps than C corps in this country, way more pass-throughs. You get outside this little valley here, and people, they don't form C corps. Here you do, right? Because if you're a typical technology startup that hopes or expects to have venture funding, this is one of the main reasons why you would do that. There's some other stuff too. We could do a whole hour on that. But that's one of the things you want to keep in mind. So the question is, people come to me and they say, well, I want to get venture funding. I think I'm going to get venture funded. I hope I do. But if I don't, do I still want to be a C Corp? And the answer is no, probably not. Really, you only want to be a C Corp if you have to. And that means because the VCs are going to force that on you. And if you've heard Gary Jenks speak here before, he talks about how VCs expect explosive growth in their companies. So if you're the kind of company, if you're a technology startup where it's either, explosive growth or nothing, if it's either VC funding or you're not going to succeed, then C Corp is probably the right answer, right? I call it go big or go home. If you're a go big or go home company, that's probably the right answer. If, on the other hand, you could have a very nice lifestyle business, throw off some revenue every year, support yourself, have some income, then maybe that's not the right answer. A lot of times what we'll do is we'll start with a limited liability company and we'll convert that to a C Corp down the road once we know a little better whether we're a lifestyle company, whether we're more like the yogurt shop on the corner, or if we're more the next Facebook, right, or Google or something. We got a lot to cover, so I'm not going to spend much more time on that. But the second thing I want to point out, choice of jurisdiction, because I do get a little pushback on this every once in a while. Again, this is driven, there's lots of reasons why we choose Delaware. I'm a California lawyer. Actually, I'm licensed in 6 or 7 states, but 99% of the companies I form are under Delaware law. even though that's one of the states I'm not licensed in. The reason we do that is because Delaware is just so superior, I think, to other states. It is accepted internationally. It's got a corporations code that sort of makes sense. They got a Secretary of State's office that we can deal with, unlike California's. But one big reason is because the VCs will want you to be a Delaware corporation. They want it for governance reasons. Unlike a California corporation, a Delaware corporation allows you to abrogate what they call class voting. So in California, if you got your class of common stock that you founders have, and then you got a class of preferred stock that the VCs have, in order to sell that company, a majority of shares of both classes have to consent to it. And you can't vary that in your organizing documents. In Delaware, you can. Well, the VCs don't want to be held up, by a majority of the common shareholders. When they want to exit, they want to exit. So they want it all to vote together as one class. You can do that in Delaware. It's the number one reason VCs make you pick Delaware. It also allows you to disclaim fiduciary duties. It has a good body of law. The law is applied much more clearly and certainly than a lot of other states. So there's lots of good reasons. But the moral of the story is, if you're thinking about venture funding, just start in Delaware. That's where you're going to end up. It's not that expensive. It's not that big a deal. There's no additional tax liability. There's a few fees you got to pay to the state of Delaware. They've got their own, Nigerian scam like everybody else, every other state. But other than that, just start in Delaware. Okay, let's now that we've gotten past some of the introductory formation stuff, let's kind of get to the guts of it. So those of you who have been here before and have heard me before, how many of you have heard me before, by the way? How much? All right, well, you're going to hear this again. Sorry. I was on a panel with, we're being recorded, we've got to be careful. I was on a panel with some VCs several years ago, and one of the VCs had mentioned that their most successful by far investment was a company they invested in that eventually did a form of music sharing and delivery. I won't say which one. And the investor said that at the time they invested, they did everything wrong. Turned out to be their biggest success, made their fund, hit their numbers, covered their carry, but they did everything wrong. First of all, they invested in a recession. It was in 2008. The business was illegal as they invested in it because it was violating copyrights all over the place. It didn't have any the technology didn't work. They couldn't get it to work. They did everything wrong. They did one thing right. They picked the right founder. Because that founder, he just kept pivoting and kept innovating and kept changing until he came up with a model that was a success. And now they're one of the biggest, most dominant players in their industry, in their space. Team is super important, and I know that sounds axiomatic, and it sounds a little trite, but it's true. That's the number one thing your VCs are going to look for. So when you think about putting together your team, I think you should have a technical co-founder. I think that's super important because you got to have somebody that's going to be really motivated, to put their all into this company. And startups, as you know, it's hard, right? Almost as hard as my job. It's really hard. You got to work long hours, 7 days a week. You're not out at Burning Man. You're here learning, right? Because you've got a startup that you're fostering. Right, so you want people who are going to be that committed, and to get them to be that committed, maybe we ought to be committed, I guess, but to get them to be that committed to the company, they should be founders. So technical co-founder. I'll tell you another secret about this that people don't talk about as much. You really want somebody on your team, ideally a co-founder, who has domain expertise. That's important. I see a lot of companies that just won't get in the door because the founding team, they don't have anybody who really understands the industry. So we do a lot of work with food and agriculture companies, technologies around food and ag. Right? So we see a lot of very smart technical people that are developing solutions, but they don't really know much about the industry. So I just tell them, I say, you're not going to go anywhere until you can get a co-founder who's got some relevant experience, or if you can't do that, then for God's sakes, at least get some advisors. Get a farmer to be your advisor, if that's your industry, or a supply chain guy, or somebody like that, right? Because that domain expertise is really important, because otherwise, and every VC knows this, otherwise you end up building really cool gadgets that nobody wants or needs, and you end up solving problems that don't exist. So keep that in mind. So 2 things about team. Technical co-founder, because you got to motivate these people, and domain expertise. If you do fintech, get someone who's been in the financial services industry. That's another complex industry that you really kind of have to have that inside baseball. Almost all of them are like that. Health tech, I think it's helpful to have people who understand the industry. Now, advisors. What do we mean by advisors? We don't mean consultants. You know, I guess they could be, but that's not who we're talking about. We don't mean directors. We mean people that have specific expertise that you need, just in one little narrow thing, right? I serve as an advisor to a lot of companies that just need something that I can do. And you'll have technical advisors, you'll have business advisors, people who know the market, who know the industry, who can go out and get you a whole bunch of customers, stuff like that. And you'll reward them with equity. We do a whole thing around that. So number 1 is team. Just right out of the gate, just get the right team together. By the way, when you go see the venture capitalists, it's less true now than it was 10 years ago because everybody has like a seed fund now. But still, you oftentimes will get one shot at these guys, right? So you don't want to hear this from them. You don't want to get lots of good advice and no money, which happens a lot. And if they come back and say, yeah, we would have liked you, but you didn't really have anyone on your team that filled these holes, right? So kind of have that figured out before you even go in. Did you ever anyone read the book Good to Great? It's an oldie but a goodie. Of course you have, Steve. Anybody else here? A couple people. So in the book, you know how they make the point that whenever you're putting a great company together, what great companies do is they figure out what seats on the bus need to be filled. Then they go find the people to fill the seats. Good advice. Figure out what you need and then find the people that'll fill it, rather than finding your passengers and hoping you can find a bus for them later. We covered this just a couple days ago. I'm going to pause on all I'll say about vesting, so I don't bore the people that have been here before, is just make sure you have vesting in place. Venture capitalists will insist on it, and they'll even make you restart your vesting if your vesting is not aggressive enough. So there's a whole thing we do on vesting here, so I won't go over it again. But keep in mind, you're going to have that. Just sort of get used to that now. Now, there's things you can do to protect yourself, right? You can have vesting that will give you some acceleration. Does everyone know what I mean by vesting? That's the idea that you earn into your shares as co-founders. And usually we do, some people call it reverse vesting, where the company has a right to buy your shares back at a very small amount, cost, which is close to nothing, if you should leave the company. So for example, if you have a 4-year vesting schedule and you stay with the company for 2 years and then get kicked out or leave, the company can buy half of your shares, 2 years worth, back for almost nothing, but you get to keep the other half of your shares. That's a vesting concept. And to protect yourself, again, it used to be if you suggested acceleration, the VCs went nuts. But now we've kind of settled on a market standard that you can have provisions that say, look, if the company gets sold and within 6 months or a year of that time I get fired, then I should get additional shares vested, right? You can do stuff like that, but you can't, this is one, you ever heard, back in North Dakota where I'm from, we used to say that pigs get fat and hogs get slaughtered. This is one where pigs can get fat and hogs can get slaughtered. You want a vesting schedule that gives you some reasonable protection, but if you get a little too piggish about it, you'll start all over and have to renegotiate the whole thing. Management and control. So let me talk a little bit about that. Corporations, as a matter of governance, are owned by shareholders but managed by directors. You will have a board of directors. You should start off with 3, no more than that. And you should understand that when you go to the VCs, they're going to want at least 1 board seat. We'll talk more about that later, right? So that's the board of directors. But that's not the end of the story. The directors, of course, select officers that sign contracts and deal with the day-to-day business. But keep in mind that at the board level, you're going to have a lot of people that might have a stake in your company. And they might want to have a say, and they want a seat at the table. But we want to have a small, odd-number board just to manage it, just to have a manageable group. So what do we do with everybody else? We give them an observer seat. It means they can come to the directors, they can sit in a room, they can offer their bright ideas. They just can't vote, right? They can't vote. And we see that's a good way to bridge that gap. So keep that in mind. By the way, with your company, if you have, anyone have co-founders? Really? Well, when you do get co-founders or other board members or directors, just keep in mind that when the VCs come in, usually somebody has to come off the board. Just keep that in mind. It might be an uncomfortable conversation that you may have to have down the road. So another reason to not have too big a board when you're organizing your company. All right, let's get into some of the meaty stuff. Who has ever heard of super voting stock, Class F stock? It is a brilliant idea that we all love, that some of us love to hate. So the idea, this is what Zuckerberg has at Facebook. The idea behind Class F stock is it's common stock. So you've got your founders, and you divide up the stock of the company. It's common. It means it's the residual. It's what's left over after you pay all the creditors and any preferred stock. Then you got the common, and you divide up the proceeds of sale of the company pro rata, or dividends come out pro rata in accordance with your common shares. Now, also voting is pro rata. It's 1 share, 1 vote, generally. So you might have a company where the founder will say, I need to keep control, voting control of this company. Like I don't have a lot of cash, I got a lot of stock, that's my currency now. I'm going to use that to pay all my service providers. So I'm going to have all these knuckleheads having stock in my company, but I don't want them running the company. I don't want them voting me out, for example, or firing me, changing the board and firing me as CEO and all this stuff. So what they'll do is we'll create a special class of stock, this Class F stock, and we'll say my class of stock has 10 votes for every share and everybody else has 1 vote for every share. And that way I can control every decision. Sometimes you see that. When you see that, it's for somebody who really knows how to read a cap table and is strategizing to the nth degree and thinking ahead and thinking, well, geez, when these options exercise or when these shareholders come in, they're just looking way ahead. They always want to have that voting control. Okay, it's okay at an early stage. I try to talk people out of it, but it's not the end of the world at an early stage. Just keep in mind that my experience is that once you get to the VC stage, they're not going to let you keep that in place, right? They're going to make that go away, the investors, because they don't want, unless you're Zuckerberg, then you can do whatever you want, I guess, if you're that hot. But otherwise, for most companies, it's going to go away because, first of all, they don't want any one person having that much control in the company that can block what they want to do. And also, it's just another complication. It just complicates the cap table. So usually, just be prepared to give that up if you decide to do that at all. But think really hard if you really need it. Don't put this in place gratuitously. Really take a look at the cap table and say, do I really need this in place to accomplish what I want to accomplish? I might have control without this stock for quite a long time into this company's life. So, but that's something that is in the Valley. It's legitimate. It's sometimes used, but don't plan on having it forever. Okay, we're going to talk about Steve's favorite topic, patents. Steve Covey is our patent guy in the back, and he's going to correct me if I say anything wrong. So patents, I'm not a patent lawyer. I do corporate and tax, but I love to talk to patent lawyers just to get their perspective on what these things are and whether they're valuable or not. And I've talked to a lot of them. And here's something really surprising that I have found. I have found that investors put more value on patents than patent lawyers do. That is my perception. It's surprising, it shocks me. I talk to a lot of patent lawyers who tell me, they really probably shouldn't bother patenting that. It's not that valuable, it's not that great. I hear that a lot, that idea. And when we get to the Q&A, we can debate that a little bit. But investors seem to like them. In fact, there are formula for valuing companies that just take the number of patents and multiply every patent by $1 million. That's part of the valuation. That's something that people actually use. People with money will actually use that. So, so I think it's good business to have patents. Although, your lawyer might say it doesn't give you all that much protection. And I'll tell you why in a minute. Just keep in mind, it's, you get protection for 20 years. Still 20 years, right, Steve?
Mostly, yeah.
Yeah. And when you do a patent, what you're doing is you're taking all your trade secrets and you're publishing them publicly. So now the whole world knows what you're doing and how you're doing it, right? That's the trade-off, right? You let everybody know, but you get federal protection for that patent. So that's the trade-off. Second type of IP. So, and by the way, you're a tech company, so IP is important. We used to sit around and debate, does IP really matter? Maybe it's all about brand and it's all about team and it's all about people. I think, and different people will say different things, I think IP definitely matters in this valley. IP matters. And IP means intellectual property. That's different than technology, right? Technology is actually the how-to and what you're doing. IP is the legal protection, right? That's how we classify that as a legal matter. And by legal protection, I mean ownership. And by ownership, I mean you have the right to keep other people from doing what you're doing. Super important, right? When the VC invests in you, they're going to want to know that there's not some competitor that can sit up across the street and do exactly what you're doing using your same ideas. And that happens all the time, by the way. I see that a lot. In fact, I got a client who just got indicted now for trade secret theft who's been accused of doing something like that. Won't say who it is. Okay, trademarks, second type of IP. I want to pause on this because this is, again, way more important than people think. And those of you who've seen me speak before, you've heard me talk about this a lot. But when you go to the VC, they're valuing their company. They're going to value based on your potential, right? And a big part of what they're looking for is just building that user base. And once you sit down in the board meetings with VCs, it's kind of it's a transmogrification of values in a way, because they're not even thinking about EBITDA. For God's sakes, they don't want you to have taxable income, because then you got to pay tax. Instead, they want you to just build that user base and build that goodwill asset, right? And I've heard that. It's like, gee, should we charge more, and make some money? Or should we do freemium, and just build our user base? The answer is always they're going to build a user base. And I'm speaking generally, and it depends, on your business, et cetera. But just keep that in mind. The underlying legal concept here is they want you to build up a really good brand, right? And that brand is and that's their assurance that people are going to come back again and again to the site, right? You're going to get eyeballs on the site, whatever your product is. And whatever it is, doesn't have to be a website, it could be anything. It's just that expectation that you've got continuing customers coming back. Well, that is going to be inextricably tied up and linked to your trademarks. It's your logo, it's your name, it's your marks, your service marks. So the protection of those marks is going to be very important. And when you get into due diligence in your financing, you will be surprised at how carefully and thoroughly the investors are going to vet that and check that out. Make sure you really do have those rights. And for good reason, right? You get a cease and desist letter, for violating somebody's trademark and you can't use it anymore, you're kind of done, right? You're kind of out of business, or at least you have to go back to square one. So I raise this now because if you're getting ready for VC financing, get this nailed down in advance. The last thing in the world you want is to find out in due diligence you got a problem. And then you really are done. Plus, you look bad. Your reputation is going to take a hit. So first you do your Google search, then you go to the Patent and Trademark Office and you do a knockout search, then you go file a federal registration. People focus on patents because we hear about that and they go into the valuation formula. Okay, that's a really good offensive measure, I guess. But think about trademarks as a defensive measure. You don't want anybody else being able to stop you from using that mark. And then finally, the third leg of the trilogy, I guess, is trade secrets. Do you know what I mean by trade secrets? So trade secrets are three things. Okay, number one, it's got to be valuable information, right? Valuable information that you use in your business, commercial value. Number two, it has to be secret, so it's not commonly known. And number three, and this is the big one, you have to take reasonable efforts to keep it secret, to maintain its confidentiality. This is where companies mess up, right? Because when that VC is investing in you, yes, they're investing in your goodwill, and they're investing maybe in your patents, they're investing in your team and all this, but your IP, for most companies that I work with, I really think trade secret is their most valuable asset. You know, it's the how-to, you know, the know-how, how they actually do it, that they haven't patented, you know, because maybe it's changing too quickly, or maybe it's not patentable. So it's important to protect that. And it's super fragile, really easy to lose this. They say your employees walk out the door, they often walk off with your trade secrets, right? So we have to protect it by having good NDAs that everybody signs, non-disclosure agreements, by having proprietary invention assignments, proprietary information agreements and invention assignments that everybody signs, by doing physical security, by having keys, you know, by not letting any one person see the entire project. So what's the most famous trade secret in the world? Anyone want to tell me? No, Steve, you can't answer. You already know. Anybody? Somebody said something. Coca-Cola. That's right. Who said that? Oh, okay. That's right. Coca-Cola, most famous trade secret in the world. Why do you suppose Coca-Cola, they could have patented what they're doing? You know, they got this formula. It sits in some lawyer's safe in New York City or Atlanta or wherever they are. Why do you suppose they, I guess Coke's in New York and Pepsi's Atlanta, right? Anyway, why do you suppose...
The other way around, Pepsi's in Purchase, New York, and Coke is in Atlanta.
Okay. I knew one of them was in Atlanta. Thank you. Why do you suppose they do that? You know, why didn't they patent it? Why are they relying on trade secret?
Because a patent has a limited life. Well,
Patent has a limited life. Coca-Cola, it's been a popular formula for more than 100 years, right? If they had patented it, it would have been public, and 20 years later, they lose their patent protection, and Coca-Cola would not be the dominant player in the market that it is. So think about your company that way. So when people ask about, gee, should I rely on trade secret or patent, there's a couple of things you should consider. All right, one is the duration of legal protection. So how much, you know, in this valley, 20 years is 20 lifetimes, really. It's a long time. You know, so we don't really worry about the duration, but in some industries you do. But keep in mind, you're disclosing this stuff to the public, right? So another issue is what you have even patentable. Right? We got some law here 5 or 10 years ago that made business methods really hard to patent. You know, they kind of changed the whole landscape for software patents. People still do it. You find clever patent lawyers that can draft claims that'll do it. You know, is it even patentable? Can it be reverse engineered? If so, you probably want to rely on patent, not trade secret, because people are going to figure out how you do it. And that's what a patent does. It gives you an exclusive right, even though someone else might independently figure out how to do the invention. And then secondly, is this something that the company can keep secret? Remember what I said, your employees walk out the door, they might walk out with your trade secrets. That happens all the time. Just read the papers. So this is a discussion that's worth having, you know, and it's kind of an aside, but it's a discussion worth having because you're going to have patents and you're going to have trade secrets. It's a matter of strategy. What do you want to patent? What do you want to rely on trade secret for? Again, another slide you've seen a lot, but this slide comes right out of the VC handbook. You know, when you're thinking about putting your company together and building something that you want to take to the VCs, you might think about how the VC looks at it. Remember what I said about explosive growth. You know, they're set up to take really big risk, but they want really big returns. So a lot of times I'll see companies, they'll come in and say, I've got this really great idea, I got this invention, I'm going to patent it or protect it, and then I'm going to license it so I don't have to spend a lot of money on facilities and manufacturing, etc. Well, maybe, but maybe not, because that doesn't sound like a VC play. You know, manufacturing a product sounds like a VC play, right? Because you've got this big negative cash flow, you need all this money from the VC, but you've got a bigger upside on the back end because you're not paying a royalty to anybody, right? So it's a matter of strategy. When you're putting your company together, if you're thinking VC, you probably should not be thinking we're going to be a passive licensing agency of our brilliant invention. Okay? And then joint ventures, I just want to mention that the market will accept the fact that when you go into a foreign country, you're going to have to give up some rights in that foreign country to get into the market. You're going to have to give up a little ownership, right? You're going to have to grant licenses. You might not have exclusivity. You might not have the right to that geography in perpetuity. The market will accept that. So that's a legitimate use of a joint venture. But be careful that early on in your company's life, you don't give away the farm. I see that a lot. In fact, I feel like when I look at these agreements, I'm protecting my client from themselves as much as from anybody else. Because there is this tendency to just get that first revenue. God, you'll do anything for it, right? You got to get traction for the VC. And you end up giving your IP away, and that's it. You know, you're done. You've lost that market. And I tell in my other talks anecdotes about companies that have given up strategically little markets to prove their product, and the market will accept that. But it was very strategic, it was very well planned, very well thought out. IP ownership, we all know by now that you need to get ownership. So the cap table. I won't spend a lot of time on this. I want to get into some venture terms, but you're going to have to get comfortable knowing your way around a cap table. Sooner the better. Here's a sample cap table. I'm not even sure where I got this from. You know, I like to back into the cap table, figure out where we want to be after Series B, and then back into it, say, well, that means we'll take this much B and this much A and this big an option plan. But for now, let's just say that this is a typical cap table. You know, you'll have your founders on there having common stock. You'll have your employees, consultants, advisors. They'll have stock options or possibly common stock early on, but it's common, right? So residuary. The investors come along, friends and family. Please always do convertibles with them. Don't issue them stock. You'll be sorry, right? It's just too early to do that. You can't value. They're going to want stock because they want to value the company. My investors in the audience will back me up on that. But as a company, if you can defer that valuation decision as much as possible by doing convertible notes, you're way better off. One thing I want to mention about this, because this is a mistake, it's kind of subtle, but I've seen it come up, where the company, you've got common stock, that's your currency, right? You don't have cash, you've got common stock. So you're going to give stock to everybody who does work for you that you can. You know, people just go hog wild with their stock. I have had it happen where they've given away too much common stock. Now, what does that mean? How is that possible? It means there are so many stakeholders out there holding common stock that the venture capitalist comes along and they say, wait a minute, you don't have enough common stock left over for the founders. You don't have enough common stock left over for the really important people that are going to drive this company, right? So I can't put my cash in there because you're going to have to pay them too high a salary because you don't have enough common left because you gave too much common to that former founder who left and was vested and took all that common with him. So that's something to be careful about. I've seen companies tank over that. So get really good with a cap table. Spend a lot of time thinking about it and make sure that the people that are on your cap table deserve to be on there, that they really have contributed, right? You would never want to give an early advisor 5%, for example. I've seen companies do that and regret it later. It's something where you should take advice on, for sure. Seed funding, this is what I was talking about, safes and convertible notes. So instead of giving your early stage investors equity, meaning you have to price the round or value the company when it's too early to value, we do convertibles, simple agreements for future equity, convertible notes. And what this means is that somebody gives you the money today, but they get stock later when you have a VC in the mix professionally valuing your company. Okay, that's a safe, that's a convertible note. That's the way to do it. Now, we talked a lot about this on Tuesday, pre and post money. I want to revisit it again because there's something a lot of you are doing that you should stop doing. And that's that you're doing it yourself. You're going online, you're going to the Y Combinator website, you're downloading their form of SAFE and using that in order to raise money. So aside from all the securities law issues with that, you know, you're also probably giving up more of your company than you think you are because SAFEs can actually be pretty subtle. When you get really good at cap tables, and you can do pro forma cap tables and do what ifs, you'll see what I mean. But there's this concept of pre-money versus post-money. So here's the simple example, because you'll want to think of this, because not all safes or convertibles are created alike. So if I tell you that you're the investor and I want $1 million from you on a $4 million pre-money basis, what percent of the company do you have? Somebody say 20%, right? Because you've got $1 million divided by $5 million of total value, $4 million pre. If I tell you that I want $1 million from you on a $4 million post-money basis, much different, isn't it? Now you, Mr. Investor, have 1 million over 4 million, right? You got 25%. So different safes calculate that differently. That money will convert on a different valuation assumption. You got to be careful with it. I've seen people be surprised by that many times. And the problem is Y Combinator started out with a company favorable pre-money safe, and then for some reason just switched their form. So everybody who was going online downloading it, actually started giving people a better deal without really realizing it. Series FF stock. I want to mention this just briefly because it doesn't work. But this is the idea that here's a scenario. You're a founder, you've done really well, you've built the company up, and you've been eating ramen noodles for the last 10 years, and now you finally got an investor that wants to put money in, and by golly, I should be able to take some money out of this sucker, right? So I'll tell you what, I'm going to sell some of my shares to the investor, while the company sells its preferred stock. There's all sorts of tax issues with that. So there is this instrument that popped up out there. I think one of the accelerators came up with it, where the founder has this Series FF stock, and it has this feature where it converts to preferred stock when you do a venture financing, so you can sell preferred to the investor, right? The VC doesn't want your crappy common stock, right? There's no preferences. It's the residuary. It could end up with nothing. They want preferred stock. So founder wants to sell, they want to buy, so we convert the common to preferred and then sell it. Happens automatically. I'm just telling you it doesn't work as a tax matter. You end up in the same place as if you went and sold common stock at a preferred stock price, and that's compensatory. It means you've got a big tax burden on that. So stay away from that. If people talk about it, don't do it. Employees, I want to get ahead to some financing stuff. Let's skip this and come back to this is alternative financing. We want to talk about getting ready for venture financing. By the way, what happens, do you suppose, if you've done any of this stuff before you've gone to the VC? What happens if you've done a crowdfunding campaign or crowd financing campaign? Reg CF, for example, on Start Engine. Or if you've done an ICO. Everyone know what an ICO is? An initial coin offering, you sold tokens. Or if you've done royalty financing. I see that come up a lot. That's where the investor gives you X dollars and you say, Mr. Investor, you get an X percent of this revenue stream, for some number of years. Those are all relatively negative things. They're not deal breakers. It's not the end of the world. But VCs view them as all relatively negative, right? The royalty financing, that's a lot like debt. They will view that as debt, right? So now you got a company with debt. Their money has to go pay that royalty before they get a return. It's not good. ICOs, basically you've allowed people to basically pre-sell the product and take money off the table. Some VCs are okay with it. These days, most, I think, would view it as a negative thing. Crowdfunding, I keep telling people not to do it. They'll never get financed. Then they do it and get financed anyway. So, don't take my advice on this. But you end up having a lot of shareholders on your cap table. I guess I've softened on this over the years, having seen a number of successful ones. But be careful about that. I wouldn't do it unless you need to. It's a very expensive way to raise money. And it does make your cap table more complicated because now you've got all these additional stakeholders. But that one I'm more sanguine about than the other two. Okay, let's get into the term sheet. It took me almost an hour to get to this. So now you've gone to the VC, right? You're lucky enough to get that meeting. They're going to give you a term sheet. What are the essential terms, the things you ought to be thinking about? Number one, valuation. It's not the end of the world. It's not the most important thing. It's not the only thing you should be thinking about, right? Sure, it's important. You want to get a good valuation. But keep in mind that that valuation is going to be whittled away by all the other provisions in the term sheet. And by the way, my experience is that the bigger, badder, more successful VCs up and down Sand Hill Road, they, three things. One, they probably give fewer term sheets than the smaller VCs because they close way more often. If you get a term sheet from like one of the biggest VCs, you're highly likely to close. You know, they don't back out. They don't issue term sheets just to lock up your company while they shop around. They just don't do that, right? The flip side, the downside of that, or the contra to that, is their valuations tend to be lower. They just are. And the idea is when you bring a VC on, you're not just getting money, you're getting brains, you're getting intelligence, you're getting connections, you're getting advice, you're getting the fact that they play golf with the investment bankers, they're going to be able to take you public or combine you with somebody else and roll you up and all of that stuff. So you pay for that in valuation points. So valuation is not the most important thing. It is just one factor. So what could take away from that valuation? Now we get into the details, into the fine print. So there's a concept of participation in preferred stock. Preferred stock is let me jump ahead. Preferred stock is the idea that the stock gets paid before the common does. Preferred gets their money back first. So if I'm a VC and I put $1 million into your company in preferred stock, it means if you sell your company, I get the first million. So if you sell it for $1 million, I take everything, right? If you sell it for $2 million, you know, I can either take my million or take my pro rata share. So that's the liquidation preference. It's like who gets paid first. Preferred stock does. That's what venture capitalists want, always. All right, now, there's this idea of participating and non-participating preferred. Non-participating preferred means that I just get my $1 million back unless I convert my stock to common and I take my pro rata share. So if I buy 50% for $1 million, I have a choice as a VC. When you sell the company, I get my $1 million back or I get 50%. That's 1x non-participating preferred. Now, you see it less now, but just wait till the recession hits. You'll see it a lot more, participating preferred. And that means that I get my money back, but I get to participate. I also get my pro rata share of the proceeds of sale. So if I bought 20% of your company for $1 million, I get the first million and I get 20% of the proceeds of the sale. That's participating. And we don't see participating very much anymore. I used to a whole lot more. And when we do, it'll be subject to a cap, right? A cap means, okay, Mr. VC, you get to participate, but you're capped at this number. You can't recover more than 2 times your investment, you know, or 3 times or 5 times or whatever it is. So that's the difference. So be careful about that. Your first round should be 1x non-participating. If it's not, that valuation number may not be as significant to you as you thought it was. And again, this is why you got to get good with pro formas. You got to run numbers. You got to do what ifs. I've seen so many companies that the founders, they were just working for the VCs. You know, they had no idea. I don't know why they stayed with it, because everything they were going to get was going to go to the VCs. Dividends, the standard in the Valley is non-cumulative. It's paid when, as, and if. Because companies around here don't pay dividends because they don't have income, right? Remember? They don't want income. They want user base, right? So you do see cumulative dividends in private equity deals where you got actual profitable companies, not in venture deals. Not often, anyway. Whoops. Redemption rights. This is a feature of the preferred stock. So now the venture capitalist is saying, well, how do I know I'm going to get liquidity out of this? So they'll negotiate for themselves a right to sell the stock back to the company at cost plus some return. And it'll phase in over time. Now, the company is probably not going to have money to buy the stock back. So in effect, what it does is it forces the company to go sell. That's why people use this. That pops up a lot now, redemption rights. The best you can do in that is to push it way out into the future. But keep in mind, that's the venture capitalists' sneaky way of making sure you sell your company and they get when they want you to. Protective provisions, they're going to want all sorts of rights. Just keep that in mind. This is all standard stuff right here. They're going to be able to block a sale of the company. They have to consent to any amendment. They have to consent to you selling any stock that's prior to their interest. I have a whole long list. Anybody wants the slides, I'm happy to share them with you, and you can take a look at that later. Information rights, you're going to have to give financial statements, other information. They'll want audited statements, by the way. It's very expensive, but don't be shocked when you hear about it. Registration rights. I'm not going to spend a lot of time on this because I know lawyers that will just negotiate registration rights for hours. And what this is a right of the investor to force the company to sell shares in a public offering. In 35 years, hundreds of deals, I have never, ever, ever seen anybody exercise a registration right. So I don't bother negotiating it. Just give them the standard registration rights, and let's move on to the more important stuff. So don't get hung up on that. You got to pick your battles. That's not one you want to pick. We talked about board observer rights. Not everybody can be on the board, but a lot of people can be observers. Wholesale tag-along, right of first refusal. So what this means, the right of first refusal means that if you, the founder, want to sell your shares, you have to offer it back to the company first and let them buy it first. And if the company doesn't want to buy it, you offer it to the investors and let them buy it. Wholesale right means that if you, the founder, if the company doesn't buy it and you go ahead and want to do that sale, you have to take shares of the VC along with you. So if you're going to sell half your stock, you have to negotiate for them a right to sell half their stock. So they sell with you. Drag-along right is the flip side. It means if the VC wants to sell, he can force you to sell your shares in that sale. Standard stuff. Standard stuff. It's in every deal. So, that's something that you will give up. Board representation. Let me talk about the board. You've heard of the founder-friendly board, and then we're almost finished. But you want a 3-member board after your Series A round. You want 1 member selected by the founders or the common stock. You want 1 member selected by the VC, or at least 1 representative of the VC. A 3rd person, you want to be an industry luminary that everybody respects, an independent board member. Okay, that's how you want to set that up. That way you don't, and sometimes you get 2 founders and 1 VC. So if you can get that, that's great. But don't ever give up control of the board in the first round. Second round, it'll be 2, 2, and 1, right? Usually in your Series B round. But script it that way. Founder vesting, I think we talked about that. Anti-dilution, this is the last thing I'll say, Rob. Anti-dilution is really important. This is what happens, and we're going to see this happen now because we're in good times. We may be heading into bad times. But what happens if the next round, so you sell the venture capitalist stock at a $10 million, let's say, pre-money valuation, you do the financing, the next round the company's value goes down, and you still sell stock at a lower valuation. Well, the VC is going to negotiate for himself an adjustment. But this is an extremely complex formula, this narrow, broad-based weighted average formula, and it doesn't give him much of an adjustment at all. So that's what you want to do. What you want to never do is what they call full ratchet anti-dilution. With that, that's troubled company terms. What that means is that if you sold for $1 a share to the VC in the next round you sell for 50 cents a share, the VC gets twice as many shares because he gets the 50% price, not the dollar price. You never do that, so be careful. Okay, with that, I think I'm going to open it up for, turn it back to Rob.
I need to mention, though our local mission is to support entrepreneurs here in Silicon Valley, our global mission is to democratize entrepreneurship and innovation all around the world. To that end, we maintain a robust YouTube channel, youtube.com/idea to IPO. Go there, check it out. We have tons of videos there. We've documented and archived many, many of our events, and this rich, valuable content is available on demand anytime, anywhere, totally free of charge. Our partner in this endeavor is Tim Jeggers of Jeggers Films, one of the top professional videographers in Silicon Valley. So let's hear it for Tim.
Thank you, Rob. Thank you for the informative presentation, Roger. So I'm Tim. I do the videos for most of the Idea to IPO events. I also do photography. I do everything from documentation to promotional, demonstrational, how-to, testimonial. But the most important thing I want to talk about actually is the quality of this video is very dependent on you using this to ask your question so that I have nice clean sound for the video. So I just want to make a quick request. Whenever it's your turn to ask a question, we'll bring this to you. Thank you.
All right, so at this point, we're going to open it up to questions. Roger is going to answer as many as possible. He's not billing, so take advantage of the opportunity. He usually doesn't work for free. So who has a question for Roger?
Not intentionally, anyway.
Yeah, exactly. Who's got a question for Roger? All right, Bill, go for it.
Hi, Roger.
Hello.
Nice presentation. I wanted to ask you, there's an inordinate amount of entrepreneurs graduating recently from Y Combinator, demanding safe notes, no maturity date, no interest, no nothing. And as an investor, and an accredited investor, and someone who has a lot of experience in this industry, what is going on? Because none of them are getting funded, and they're burning bridges with the entire investment community to the point where nobody even wants to meet with them.
Oh, wow.
So this is something that it's not, I mean, Sequoia feels the same way. I've seen it. It's like, you know, preferred round, we'll do something fair.
Yeah.
But there's a mindset now. And on the Pi Capital website, which is going to go up in a week for accredited investors only, there's like, we're kicking out all the safe note only, no discount, no maturity date, no benefits for the investor. Think of yourself as an investor. So what's your feeling on that as a great attorney that I can attest to, where I've sent business your way, and representing the corporations typically?
Yeah, well, okay, so representing the corporations, I love safe notes, you know, and the thing is, in this valley, when this first came along, you know, people really pushed back on this, because you're right, there's no maturity date, you know, you put your money in and then you just hope. And that's way different than what we were doing before, which was convertible promissory notes, where you put your money in and there's a fuse on that, right? You better make something happen in the next up to 2 years, and if you don't, the note comes due and it's in default and it has to be repaid. And it also carries interest on it. The thinking around the safe note, and my position on this depends who I'm representing. If I'm representing a company, here's what I'm going to say. I'm going to say, look, Mr. Investor, you're taking equity risk. You don't really want a note. You don't want your 6% coupon. What you want is an equity gain, right? An equity return. So let's get rid of this assumption that you're making a debt investment in me. And secondly, we're not going to be able to pay you back anyway unless we're really successful. And if we're really successful, you don't want to get paid back. You want to convert. So let's just get rid of this fiction that we have a lender relationship. That's what I say as a company. As an investor, I say, well, wait a minute. I am loaning you money. You know, I do want to get interest on this, and I do want to be repaid if you don't make anything happen. So I take different positions. Now, what's going on in the industry is that the angel community has gotten really big and strong and powerful now. There's lots of angels out there, and angels they don't do nearly the diligence that the professional. They don't have to answer, you know, they don't have to cover 20% carry. They don't have to answer to their institutional LPs, right? So I think they were much more willing to go ahead and sign safes based on the argument that I just brilliantly made on behalf of the company. So they're just so common, and now every founder knows about them, right? And you know, Y Combinator, of course, swears about them. They publish their forms right on their website. They claim
I actually misspoke. I forgot to mention that there's no maturity, there's no discount, there's no interest, but there's no cap.
Well,
that's what I messed up when I spoke.
well,
there's
that's
no
different.
nothing.
That's
right.
different. You'd have to be, yeah. Even as company counsel, I would not tell somebody
Exactly.
to do
that
something
was really the point.
without
I
a
was making.
discount and a cap.
Right.
Does everyone know what we mean by a cap?
No one's calling their note when you can't pay. Why would you want to put the company out of business that you invested in?
And that's what happens. I mean,
Yeah, it's the no cap nightmare, I call it.
the no cap. So the discount, that's okay. That's nice to get a little bit. The discount means that your note or your safe will convert at a discount. So if the share price is $1 a share, my share price is 80 cents a share. I'll convert my note at 80 cents a share if it's a 20% discount. So if we're getting in early and seeing the future and all that stuff, you get a discount. That's another 20%, big deal. The cap is really significant. The cap means that no matter what the value of the financing is, the value of the company is in the financing, my safe note or my convertible note is going to convert at no higher than this cap valuation. So I know my $100,000 is going to get at least 1% of the company. That's a cap, right? And the reason, and I believe in caps, even on the company side, because if you don't have a cap, I've seen this happen. I've seen investors in the company trying to argue with later investors against a higher valuation because it would hurt their personal interest. You get weird dynamics without a cap. And the other thing is, from the investor side, we've all made this mistake once in our career where we've let somebody invest without a cap, and then the value just shoots, just goes crazy. And the investor says, wait a minute, you used my money to create all that value, and now I'm just getting this little teeny sliver of out of this. So to bridge that gap, we put a cap. Now, a cap's not a proxy for valuation. A cap is just this limit in case something crazy happens, right? You know, it's just like a safety valve, you know, so the investor knows that they're not going to get totally diluted out of existence. So I believe in a cap. I think you ought to have a cap. I wasn't aware that people were trying to pull these off without caps. Yeah, I wouldn't invest in that either.
It has to be fair to all parties. Having been a CEO 5 times,
Yeah.
I always think like an operator.
Yeah,
So when I see this, I go, I would have never asked for that. I
yeah,
would have been thrown out of Sand Hill Road.
yeah. All of mine have caps.
Okay.
All of
No,
them.
thank you for your opinion on that.
All right, next question.
So I'm wondering, can you elaborate a little bit more on exactly what the board would look like? So this is supposed to happen before we go to get, investors. So do we have these things prepared, and that's going to give us basically more chances of getting funded if we have all these things in place, but the board has to have the venture capitalists on there as well?
No. So what I want you to take away from this is that when you go to the VCs, when you sit down and talk to them, or any other investor, even before that, you want them focused on your awesome team and your great technology and your brilliant business plan and how you're going to change the world with what you're doing. You don't want them sitting there wondering why you look different than every other company they've seen, because you've got, FF stock or something like that. So there's a way that they expect to see your company. And the more plain vanilla and boring that you are, I'm telling you, the better off you are. That's not a time to be trying out novel legal theories. So 3-member board, someone's going to come off the board. Maybe you got some observers, you got one class of common, you got some stock out there. I would avoid the royalty financing. It's just another story that you have to tell people. I feel the same way about crowdfunding, but I've been proven wrong on that one many times, where the investors will just accept that. But just the simpler, the better, I think.
Can you explain why crowdfunding isn't your choice?
Well, it's not mine. Like I say, I've seen companies do Okay, does everyone know what I mean by crowdfunding? There's 2 kinds. There's rewards-based crowdfunding. You go on Kickstarter, you basically pre-sell the product. Nothing wrong with that, if it's successful. Okay? If it's not successful, well, that's a disaster, because now it's out there in the public that people have rejected your product. So you better be sure, that you're going to be successful in your campaign. But you don't dilute anything. Equity crowdfunding is different. It's where you go on a platform and you sell stock in your company, right? Now, if you're doing an accredited only round, I don't mind that, because you're going to have a handful of what they call accredited rich investors, and that's okay, right? That's not going to mess up your later financings. But with this, what they call Reg CF crowdfunding under the Jobs Act, you can raise up to just a little more than $1 million a year and sell to anybody, widows and orphans, provided they meet certain income requirements. Now you've got a whole bunch of people on your cap table, maybe 100 that you don't know, and they've got $1,000 each in your company. Now, I just would rather not have that. And and to me, it seems like, do you really, because to me as a lawyer, stakeholders, stockholders, safe holders, they're all potential plaintiffs, right? They're all people that are going to find something to complain about. But having said that, I have had companies go that route and then go on to do venture financings. So, it's not a hurdle you can't get over. But again, I just love the simple is better philosophy. That's why I avoid it, if I can. You might not be able to. If you're a founder, you're a startup, you're looking for money, you're not going to turn it down if you can get it. I understand that. Just trying to make your chances as good as possible when you finally get to the institutions.
Thank you.
All right, next question.
Thank you for the presentation. Would you elaborate on when would be the best timing to incorporate? Is it when the term sheet arrives, because some people do that, or how long earlier to do that? Any comments would appreciate.
Yeah, the question is, when is the best time to incorporate? I think the earlier the better. So you incorporate for 3 reasons, right? And the longer you wait, the harder it gets. And if you wait too long, you're done. You're not going to be able to do it because you won't be able to get all the constituents together. Reason 1 is to limit your liability, right? If you're operating without a corporation and you do something that causes liability, that's yours personally. That could be IP infringement, could be a tort claim, could be a bad employee. You know, we're in the Me Too movement. You know, all sorts of stuff is happening. You ought to see some of the emails I get. It could be somebody slips and falls, anything. So limit your liability. Number 2, you want a vehicle that can divide up the equity among your founders and other participants. So if you've got a corporation, you can issue that stock early on, get that all taken care of and buttoned down. If you want to wait to do that till you got a term sheet, you're just asking for trouble. Because now you've given every stakeholder a veto right, in effect, you know, to come negotiate against you. Because they might say, you know what, I want 30% instead of 25. You know, and if you don't give it to me, I'm going to sue you and you won't be able to get your financing. Number 3, it's you need a vehicle to collect intellectual property rights. You need a vehicle that can sign a contract with all of your consultants and employees and all those people that are working for you, writing code, coming up with designs, all that stuff, and you can collect it in one company. So sooner the better, I tell people. Sooner the better.
Thank you.
Right, next question.
I have a question. I know you were talking about NDAs and how important those can be. I've heard that the definition of confidential can be an issue. Can you elaborate on that in terms of being too broad? Or I remember someone saying that you have to be really careful about what you define as confidential.
You mean what's confidential information?
Right.
Well, I guess a couple of things.
It was just a conversation, and someone said that you had to be careful because it could invalidate the
Could
NDA. So
invalidate
I'm not
your
sure if you
NDA?
could elaborate. Yeah.
Steve's our IP lawyer. Steve, do you have a
Yeah,
comment
so-
on that? Talking to the
Thank
mic.
So every confidentiality agreement should have a definition in it of what's considered confidential material. Some cases, there's actually a requirement that it be marked, or if it's a verbal communication, there has to be a 24-hour follow-up. What we talked about yesterday is confidential. That's the strictest way. Everything has to be labeled as confidential. But usually, it's a pretty simple thing to say, we're defined by subject matter. Documents need to be marked, and you can specifically pick out things that you're going to want to include. If you know what you're going to communicate to the other side, it should be pretty straightforward. But there's got to be that definition.
Yeah, so it can be there's thank you, Steve. There could be different definitions. It could be anything that's marked confidential. But usually the definition is much broader. It's anything that is confidential, that the company has actually kept confidential and valuable. But it's good to read those things. It's good to pay attention. Keep in mind that you really do have to take those steps to keep this stuff confidential.
All right, next question.
So as you said that many companies actually start with an LLC and then they can convert to an S Corp or a C Corp based on what they want to do. So my question is, can we always convert from an S Corp to an LLC or to C Corp, or is there a flow that it goes through? And if they can convert, so why don't they start with like an S Corp, which has the maximum tax benefits, and then if they want to go to the VC stage, they could convert to C Corp?
Yeah, a lot of companies do that. So it's really easy to convert from an LLC to a C Corp if you know what you're doing. Just be a little careful about that because it's complicated. I shouldn't say it's easy. Let's just say it can be done, and it's regularly done. But you could trigger a tax on the conversion if you're not careful, if you don't know what you're doing. You could kind of screw up your filings if you don't know how the EINs work. You could trigger severance pay to your employees, stuff like that. So there's a process, so it can be done. The there's one kind of very arcane, subtle tax issue there. Have you ever heard of qualified small business stock? So stock issued by a C corporation in a qualified small business that's less than 50 million in assets, that's held for 5 years or more, can be sold on a non-taxable basis. In other words, the gain from that sale is not subject to tax up to $10 million or 10 times basis. Okay?
For a
Stock in a C corporation. Okay, not in an S corp. So you issue stock in an S corp, then later you terminate your S election, you will not get qualified small business stock. It's a terrible result. If you start as an LLC and you convert to a C corp, stock will be issued in that conversion. That stock will qualify. So you go LLC to C corp, you can get that benefit. Now the appreciation in the LLC interest at the time, you only get to exclude the gain or the appreciation after the date of conversion. So the longer you wait, kind of the worse it is, right? Because then you've got some built-in gain that will be triggered. I know this is getting kind of arcane, but the real reason that it's a problem, because you got to pay for two companies, basically. You got to pay for an LLC, then you got to pay for a corporation. Then you got to pay for the conversion itself, which is moving a bunch of assets around. So if you know you're going to be a C corp, just start out as a C corp. Save yourself the trouble. And if you don't know, because you might be that yogurt shop, or you might be Facebook, you're not sure which one yet, then you can be an LLC, and for another $5,000, you can see the next card, down the road. It's kind of how I look at it.
Thank you.
Where's our mic? Oh. All right.
Thank you for great talk. I'm from Japan, and I came here for fundraising, and so I want to know about the time schedule. So from first contact to get actual fund. So it takes 1 month, or of course it depends on the VCs. So I want to know average.
Okay, so we have an entrepreneur who came here from Japan to raise money, wants to know how long it's going to take. So let me tell you first of all, it's way harder than you might have heard.
Right.
And I know most of the clients I work with are companies from other countries. They've launched their company and their product in their home country. They've done well. They've been successful. So now they come to the United States saying, I'll be successful there too, and I'll raise money. Sometimes that's true. Sometimes it's not. But just keep in mind, it's not as easy as you might think. How long it takes, who knows? I will tell you one thing, though. You're way better off if you've already got a presence here in the U.S. So the dialogue we often have with my foreign clients is they come here, they sit down with the investor, and they say, yes, I'm from my home country, and if you give me money, I'll move here to California. And the investor says, well, we really like you, so if you move here, we might give you money. And that's kind of where we end. So you don't want to get in that discussion. So it's really important to have a Delaware corporation set up with an office here. It could be just a sales office, but they have a presence here. So when they ask you that question, and they will, where are you based? Trust me, they're not going to want to fly to board meetings in Tokyo, right? They don't even want to go to Stockton, right? So
yeah, I set up the company here
Good.
last month. Yes.
Good.
Yeah.
Well, once you've done that, then you can start to have, and you actually established a presence, you can start to have those conversations. Now, setting up that company means bringing everything under that Delaware umbrella. So if you've got a Japanese company, you'll want to put that under the Delaware company, at least at close. We call that a flip transaction, right? We go from Japan on top, or any other foreign country on top owning a U.S. sub, to U.S. sub being on top owning the foreign corporation, and the investors, they invest in the parent company, and they indirectly get everything. And we can wait and do that at close, but you got to be teed up to do it, I think, before you can even talk to these guys. There's exceptions to every rule, so I'm sure you've heard the exceptions, where foreign companies have come here and gotten funding. But just generally, you're way ahead if you can say you're a U.S. company.
So investor care about visa program. I don't have visa right now. So.
Don't need a visa to form a U.S. company and be a U.S. startup founder. Need a visa to be hired by your company and draw a salary, but you don't need a visa to form the company. There's somebody in the back. Oh, hey, thank you.
Question regards, doing a trademark or provisional patents prior to incorporation. So in other words, those need to later on get transferred to the corporation once it exists.
Right.
What are the complications?
Right, right. Make sure you talk to Steve Colby out there in the white shirt about that, because he's an IP, he's a patent lawyer. But the complications, it's not a big deal. You can transfer the patents. You can transfer the patent application. It's a little trickier with a trademark because you're going to, and by the way, don't do that yourself, because I've seen trademarks just completely get invalidated because the founder checked the wrong box. They said, gee, I'm using this trademark, when they actually weren't, or something like that. But you can file this thing called an intent to use. But applications can be transferred to the corporation. It's not that complicated if you do it right.
Okay, thank you.
All right. Next question. All right.
How much share would you give to the advisor?
How much equity?
Yes.
So usually it's, as a rule of thumb, advisors, they say typically get 1/4%. Now, that's just a rule of thumb. Your actual facts will be, they could be a lot less than that and up to 1 or 2%, depending who the advisor is. I use a form that you can get online from Founders Institute called the FAST Agreement. If anybody here knows what that stands for, remind me, because I can never remember. But it has a little grid on the back. It's an advisor agreement. On the back there's a grid. And you find the stage of the company, startup, growth, mature, then you find how active the advisor is, and you just find your place on that grid, and it gives you a percentage. And you just circle the percentage, and that's how much equity they get. I really like that form because it gives you a methodology for determining how much equity you give the advisor. But absent that, we usually say advisor 1/4 or 1%.
Thank you.
Yeah. And by the way, and it's equity too. You never give cash to an advisor. You give them equity. And if you got an option plan, you give them options. If you don't, you just grant them stock.
Hello. So my question is more about the kind of methodology that you would go through as a lawyer who advises these startups. To what extent, if a new client comes to you with questions about how to structure my capital structure, founders and preferred stock and all this, to what extent do you maybe try to look at that company holistically and all the different factors, and then try to match it to a template of a company you've seen before that succeeded or failed?
That's right. I'll do that. It's not legal. It's more experience. It's more having seen thousands of them. And there are great tools online, by the way. Gust has a good tool for determining how much equity. I oftentimes will use a system called slicing pie or dynamic split as a method for determining how much equity founders should have among themselves. But yeah, you see enough company, and there's good resources, and there's enough experience in the Valley that you can sort of figure it out once you understand what the participant's going to do and what they're not. And it's worth going through the exercise. You do not want to give too much equity to somebody. And if you do, just put a vesting provision in place so you can fix your mistake if it turns out to be a mistake.
Any more questions for Roger? Oh, there you go.
Just a quick one. Roger, just to clarify, regarding tag-along rights, I thought that they were the right of, say, the VC shareholders to sell their stock at the same price that the founder gets if the founder's the one who's getting the offer.
Right.
In other words, I thought it was a right for them, but not a mandate. Is that correct?
That's right.
Okay.
That's right. If I said anything different, I said it wrong.
Yeah, that's what where I was getting confused. Thank you.
Yeah, they have a right to participate in the sale. That's correct.
Follow up on earlier question. What's your thoughts of if it's already an LLC, and would you recommend to convert that to a C, or would you recommend to incorporate a new C and then dissolve the LLC?
I would convert it if it does. Well, does the LLC have any substantial assets? Does it have IP? Does it have patents? Have trade secrets? Employees? Does it have stuff? If it has, does it have a trademark? Does it have a name? Does it have a logo? If it has stuff, you want to convert it. If it doesn't have anything, then I'd just start over. Okay. Assuming you want to be a C Corp.
Yes.
Maybe, remember, we got to go through that whole analysis.
Yes.
Are you go big or go home, or are you the yogurt stand?
Yes. Okay. Thank you.
All right, let's give it up for Roger. All right, we're all set. Roger, Wendy's going to help us out.
Oh, okay, good. I don't even have to. I even bought new glasses for this, but I'll let you read the
Why don't you
cards.
pull it out and she'll read it.
Okay, it's a deal.
Drum roll, please. And the first winner is
Let's see. Fiberin.
come on down.
Oh, yay.
You want to follow with the man?
All right, thank you. Thanks for being here.
Thank you.
Thank you.
All right, and the second winner is, drum roll again.
Sushma?
All right, come on down. Good thing you entered at the last minute.
Thank you.
All right, congratulations.
And we have one more?
Winner for the night. Big drum roll, please.
Oh, wait, okay, I shouldn't look.
And the winner is
Sharma?
Sharma and Sharma. Come on down. Congratulations. So the video will be on our YouTube channel, youtube.com/idea-to-IPO within 48 hours, right, Tim? And if you would like a copy of the slides, email Roger directly.
Email me the slides.
So stick around, network, socialize, and connect, and we'll see you next time.